Welcome to the Radio Revenue Podcast.
It's great to be back.
Today, we are cracking open a document that looks, on the surface like just another standard corporate filing.
But it's really not.
It isn't. Once you start peeling back the pages, it actually reads like a survival guide for a massive industrial giant trying to navigate a world that is, frankly, kind of falling apart.
We're looking at the 2025 annual report for GE Healthcare Technologies.
That's right. The Form 10-K for the fiscal year ended December 31st, 2025. And, calling it a survival guide might be a bit dramatic, but not entirely wrong.
Right. I mean, this is a company that just spun off from General Electric.
A true legacy giant.
And is now trying to chart its own course as a standalone entity.
Exactly.
So the mission for this deep dive is, I think, pretty specific. I want to know how a company that brought in over, $20 billion last year manages to deal with three very real, very headache-inducing problems.
Okay, what are they? A global trade war with massive tariffs, a huge market in China that seems to be freezing up, and this is my absolute favorite detail, a critical reliance on party balloons.
You mean helium?
I mean helium. We are definitely going to get to the helium. But before we float away, let's ground this in the numbers. How did GE Healthcare actually do in 2025?
Well, if you just look at the headlines, they had a really solid year. Total revenue hit $20.6 billion.
Okay.
That's up 4.8% from the previous year. And they cleared a net income of $2.08 billion.
So profitable, growing. On paper, that sounds, boringly successful.
It does, until you look at how they made that money. We think of GE Healthcare as the people who build the big the MRI machines, the CT scanners.
The hardware.
The hardware, exactly.
Right.
And sure, they sold plenty of that, but nearly $7 billion of that revenue came from services.
$7 billion? Wait, that's almost a third of the whole company?
Exactly.
Yeah.
And that's really the secret sauce here. Selling a machine is a one-time thing, but servicing that machine, that's recurring revenue.
Digital upgrades, maintenance contracts.
Software solutions. It's the difference between selling a car and selling a subscription to drive the car.
Which is smart, because a hospital isn't going to buy a new MRI every single year.
But they will pay to keep the old one running. Precisely. Now, to really understand the engine here, we have to look at their four reporting segments.
The four pillars.
Yeah, you could call them that. It's like looking at four siblings who are all on, very different career paths.
Okay, so let's start with the golden child, the big one, imaging.
The heavyweight champion, for sure.
Yeah.
Imaging brought in $9.25 billion in 2025.
Wow.
And that's up 4.4% year over year. This is that core hardware business we were talking about. CT, MRI, molecular imaging.
And where's the growth coming from? Is everyone just buying new MRIs?
Not quite everyone. The report is very specific. The growth is being driven by what they call USCAN. That's the United States and Canada and Europe.
So the mature markets.
Right. And what's interesting is a lot of that 4.4% growth wasn't just selling more machines, it was selling them at higher prices.
Ah, so inflation pricing power.
Correct. They were able to pass those costs on. But while imaging is the steady anchor, the real firecracker in this report is the second segment, pharmaceutical diagnostics, PDX.
I saw this number and I had to double check it. Revenue in PDX jumped 15.6% to reach $2.9 billion. I mean, segments in a company this big usually move by 2 or 3%. How do you get a 15% jump?
You buy it.
Ah, the old checkbook growth strategy.
Well, it's a mix, but first let's explain what PDX actually does. They make contrast media.
So if you've ever had a scan where they inject that warm dye into your veins so the doctor can actually see what's going on?
That's it. That's contrast media.
So imaging sells the printer and PDX sells the ink.
That is the perfect analogy. And just like printer ink, it's high margin and you need it every single time. But the reason for that massive spike, that 15%, is an acquisition. In March 2025, GE Healthcare bought the remaining 50% of a Japanese company called Nihon Mediphysics.
NMP, I saw that. They paid around $271 million for it.
Right, so they were already partners. But by buying the whole thing, they get to consolidate all of that revenue onto their own books. It basically tightens their grip on the Asian market for these radiopharmaceuticals.
Okay, so the growth is real, but a big chunk of it came from, let's say, a change in accounting.
That's a fair way to put it.
All right, so we have the anchor, which is imaging, and the rocket ship, PDX. What about the other two?
Next up is Advanced Visualization Solutions, or AVS, revenue of $5.35 billion, up a solid 4.3%. This is mostly ultrasound.
Ultrasound feels pretty standard. Is there anything new happening there?
It's surprisingly high-tech now. They aren't just selling the, grainy black and white baby scanners anymore. This segment relies heavily on specialized ultrasound for things like cardiology and surgical guidance.
So it's very integrated.
Very. And a lot of AI is moving in, which leaves us with the black sheep of the family, patient care solutions, or PCS.
The only segment that actually shrank?
Yep. Revenue fell 1.2% to $3.09 billion.
Why? Did people stop getting sick?
Huh. Quite the opposite. This segment makes things like patient monitors and life support, so ventilators, anesthesia machines. And the report says pretty explicitly that life support solutions revenue declined.
Is that just a hangover from the pandemic? I mean, everyone bought 1 million ventilators 3 years ago, so nobody needs one now.
That's almost certainly part of what they call the unfavorable mix.
Mm-hmm.
But there's a nastier culprit in here. The supply chain.
Yeah.
The 10K admits they had trouble fulfilling orders because they just couldn't get the parts.
So they had customers with money in hand and they couldn't build the machines fast enough to take it.
Exactly. And that brings us to the part of this deep dive where the plot really thickens. We can't just look at revenue. We have to look at the world these guys are operating in.
And according to this report, the world is actively trying to make their lives more difficult.
Yeah, one way to put it.
Let's talk about the T word, tariffs.
It is a brutal section of the report.
Usually companies talk about trade wars in these, vague terms. Oh, there are headwinds. But GE Healthcare, they put a price tag on it.
They did. In 2025, tariffs negatively impacted their operating income by approximately $245 million.
Oh, stop and think about that. $250 million, just poof, gone.
And it hit their cash flow even harder, $285 million.
Yeah.
This is because of new tariffs the U.S. imposed in 2025, and then, of course, the retaliatory tariffs from other countries.
Why are they so exposed? I mean, don't they build stuff in America?
They do, but their supply chain is completely global. They have 44 manufacturing sites spread across 17 countries. So a part might be made in China, shipped to Europe for assembly.
And then the finished machine gets shipped to the U.S.
Right. And every time that product crosses a border, the customs agent has his hand out. They're literally paying to move their own inventory around.
It's basically a tax on complexity.
That's a great way to put it. And speaking of complexity, we have to talk about China.
The China numbers were really shocking to me. While the U.S. and Europe were growing, revenue in the China region fell by 4.6%.
Down to $2.25 billion. I mean, for 2 decades, China has been the growth engine for medical tech. To see it shrink is a huge signal.
What's happening? Is the economy just bad?
It's more structural. The 10K points to a few specific killers. The first is something called volume-based procurement.
VBP? I saw that acronym. Break it down for me.
It's the Chinese government flexing its muscle. So instead of individual hospitals buying machines, the government lumps all the demand together for the whole country and says, we're buying 1,000 CT scanners. Who gives us the lowest price?
So it turns a high-tech medical device into a commodity.
Exactly. It forces a race to the bottom on price. So even if GE sells the same number of machines, their profit margin just gets crushed.
But there was something else in the report about China, an anti-corruption campaign.
Yeah, this part is fascinating. The Chinese government launched this big crackdown on corruption in the healthcare sector. On paper, that sounds great. But in practice, it froze the market. Hospital administrators became terrified to sign big purchase orders with foreign companies because they didn't want to attract an investigation.
So the checkbook is locked in a drawer because everyone's afraid of going to jail.
Pretty much. So you've got tariffs hammering you at the borders, and your biggest growth market is freezing up from the inside.
And we haven't even touched on Russia.
Russia is the third headache. So GE Healthcare is still shipping there. They use what's called a license exception for humanitarian medical supplies.
Which makes sense ethically. You don't want to deny civilians an MRI scan.
Right. But the administrative burden is immense. They have to prove every single shipment is for medical use and medical use only. It's slow, it's expensive, and the compliance risk is just huge.
So if you're the CEO and you're looking at this map, hardware is getting expensive to move, China is shrinking, what do? You can't just sit there.
You pivot.
Yeah.
And you pivot hard. And that brings us to the strategy section of the report. This is where GE Healthcare is trying to change what kind of company it is.
They're buying their way out of the hardware trap.
They call it inorganic growth. I'd call it spending billions of dollars to survive. The headline deal was announced in November 2025, the acquisition of a company called Intelerad.
$2.3 billion in cash. That is a massive bet. So who is Intelerad?
Intelerad is a software company. But specifically, they focus on medical imaging management for outpatient settings.
So not hospitals?
Not just hospitals. Ambulatory clinics, radiology centers down the street.
I see the play. Hospitals are clogged up and they're broke. The real growth is in all those local clinics.
Exactly. And more importantly, Intelerad is a software and a cloud play. It moves GE Healthcare away from just selling the box to being the operating system for the entire radiology department.
They want to manage the workflow, the data, the images.
And here's the key.
You don't pay tariffs on software.
Bingo. You can email a software license to China or Europe without paying a single customs duty. It's a defensive move against trade wars just as much as it's a growth strategy.
And they're not stopping at software, though. They seem obsessed with AI.
They're building an ecosystem. We talked about them buying NMP for the contrast media. They also bought two other companies, Yagi Software and another one called Icometrix.
Icometrix sounds like a villain in a superhero movie.
It does, but their tech is actually kind of heroic.
Yeah.
They use AI to analyze brain scans for neurological disorders like Alzheimer's and MS.
Okay, so let's connect the dots here. This is the ecosystem you're talking about.
Right. Just look at the value chain. Step 1, GE sells you the MRI machine. That's imaging.
Okay.
Step 2, GE sells you the radioactive dye to light up the brain. That's PDX and NMP.
Got it.
And now, step 3, GE sells you the AI software that actually reads the picture and helps diagnose the Alzheimer's. That's Icometrix.
They own the hardware, the chemical, and the diagnosis.
That is the moat. If a hospital buys into the GE ecosystem, well, they're stuck in a good way. It makes GE indispensable. It stops them from being just another vendor.
It's a brilliant strategy. But, and there's always a but, all of this high-tech wizardry still relies on the physical world. And this is where we get to my favorite part of the 10K.
Helium.
The helium. The report literally lists helium as a critical raw material risk. Now, I know we use it for birthday parties, but why is a $20 billion medical tech giant sweating over helium?
It all comes down to physics. Inside an MRI machine, you have a massive magnet. For that magnet to work, it has to be superconducting.
Which means zero electrical resistance.
Exactly. And to do that, it has to be cold. Incredibly cold. We're talking almost absolute zero.
And let me guess, liquid helium is the only thing that works.
It's effectively the only element on the periodic table that can stay liquid at that temperature. Without helium, the magnet warms up, the superconductivity is lost, and the MRI just shuts down.
So no helium, no MRIs, no AI diagnosis. The whole ecosystem collapses.
Basically. And helium is a finite resource. It's mined from the ground. Supply shortages happen, and they cause massive price spikes. The report highlights this as a genuine operational risk.
Wow.
If they can't get helium, they can't even test the machines in the factory before they ship them out.
It's just wild that this high-tech AI future is dependent on a gas we use to make our voices sound funny. But it's not just helium, is it? The report also mentions iodine and rare earth minerals.
Right. Iodine is the key ingredient for the contrast media we talked about. No iodine, no PDX revenue. And rare earth minerals are used in all the magnets and electronics. Which brings us right back to the China problem.
Because China controls the rare earths.
They control the processing of a vast majority of them. And the 10K explicitly notes that China tightened export controls on rare earth minerals in 2025.
So China isn't just a difficult place to sell to, it's becoming a dangerous place to buy from.
That is the double-edged sword. GE Healthcare is trying to de-risk away from China as a market, but their supply chain is still anchored there for these critical materials.
So facing all of this, tariffs, rare earth blockades, expensive helium, how is the company actually paying for all these acquisitions? $2.3 billion for Intelerad is not pocket change.
They're putting it on the credit card. Or the corporate bond market, rather.
Let's look at the balance sheet.
They have cash on hand of about $4.5 billion. That's up significantly. But their total debt now stands at roughly $10 billion.
That is a lot of debt.
It is. In 2025, they issued significant new senior notes, which is basically borrowing from investors to build up that cash pile to pay for all this stuff.
So they're leveraging up. They're betting that the future growth from software and AI will be worth more than the interest payments on that $10 billion.
That's the bet. And while they're spending money on new companies, they're saving money on people.
Yeah.
We have to address the restructuring line item.
I saw that, $120 million spent on restructuring.
In corporate speak, restructuring almost always means layoffs. It means closing facilities, terminating employees.
It's cost of efficiency.
That's the cost of legacy. Remember, they spun off from GE. They inherited a lot of bloat, a lot of overlap, And 3 years later, they're still trying to slim down to protect their margins against all those tariffs and headwinds we talked about.
It really paints such a complex picture. You've got this legacy hardware business, imaging, that's generating all the cash, but it's under siege. And then you have this nimble, aggressive pivot toward AI and pharma.
That is the story of 2025 for GE Healthcare. It's a transition year. They delivered strong revenue growth, but let's be honest, a lot of that was raising prices and buying revenue streams. The actual underlying volume growth in the core business was challenged.
It really feels like they're trying to outrun the hardware problems by becoming a software company.
I think that's the key insight. You look at Intelerad, you look at the recurring revenue from PDX. They are building a business that doesn't rely solely on shipping heavy metal crates across hostile borders.
Because shipping atoms is hard, but shipping bits is easy.
Precisely.
So this raises a really big question for you, the listener. We think of GE as this industrial giant, big machines, big factories, sparks flying. But as trade wars make moving physical objects harder and more expensive, are we watching the end of the manufacturer and the birth of a tech company?
It's a provocative thought. If the value is really in the data, the diagnosis, the cloud workflow, maybe the MRI machine itself eventually just becomes a commodity.
A commodity that still needs helium, though.
Never forget the helium.
Well, that wraps up our deep dive into the 2025 annual report of GE Healthcare. A fascinating look at how a standalone giant is navigating a fractured world.
Indeed. From rare earth minerals in China to AI analyzing brains in the cloud, it is all connected.
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.